Well, thank you, Michael, and thank you for preparing and presenting this excellent seminar. As far as your condo in Spain, maybe yours was rustic, but some of the places where I've stayed in Spain when I did the Camino were a little bit lower grade than rustic, but it was an enjoyable experience anyways. I didn't get any bed bugs. Just to remind people that your questions can be put into the chat, and we will start with the first one here. Are REITs a buy and hold type of investments or traded more often?
Yeah, I think that REITs should be treated similar to investment real estate. With investment real estate, you're not trading it very often. You're buying it for the long term because you want income. And I think that I would treat most of these REIT ETFs in the same kind of way. I just put it away, and particularly if you want it to generate income in something like a registered income fund, you want to hold it for the long term, I think.
Yeah, I think that would be like one of these axioms that you use. It's like a bar of soap. The more often you use it, the less, the smaller it gets. And we have another one here that deals with something similar. In 2019, the Globe and Mail recommended Morguard REIT at $12. It's now trading at $5. So is it common to see such a decrease or disastrous loss?
There have been some that have had substantial losses, particularly ones that had, for example, offices. There were office REITs. There's another one called H&R, which owns a lot of office properties in Alberta. Well, guess what? It's not doing well. Similarly, hotel REITs have not been doing well. And obviously retirement residence REITs have not been doing well. On the other hand, REITs such as I mentioned, industrial and apartments have done well. So rather than picking individual REITs, which I don't think, I don't like picking individual stocks or anything. I prefer to let experts do it for me. And so when you have a situation or an investment like the REIT ETF, I think it's well worthwhile paying them 75 basis points or 0.75% to use their knowledge and brains to pick the REITs that are going to hopefully perform well.
You also have to remember that the value of the stock in this case is one dimension. You have to look at the income that it has generated. Has that income increased or decreased significantly? And look at the capital gain or capital loss, because if the person who asked the question was to divest of that particular Morguard REIT now, they would of course incur a capital loss, which can be used to offset capital gains. Okay, next question is, would you compare Ottawa residential with Toronto condos and REIT? What would the numbers be if it was apples to apples? I'm not sure. That's a difficult question.
Well, all I was trying to show were some alternatives. I think that for most of us here in Ottawa, if we were to buy investment real estate, we'd probably buy it in Ottawa because we know Ottawa and we know the different neighborhoods. So I was just comparing the idea of buying investment property in Ottawa with simply buying a REIT ETF. I threw in Toronto because the Toronto market has obviously been stronger over the past 10 years than Ottawa. And a lot of people have remarked about how much property prices have gone up in Toronto. And I just wanted to show that despite that, some of the REIT ETFs have performed at least as well and perhaps better, and with none of the issues of owning real estate. And for example, owning a condo in Toronto right now, an investment condo is probably a fairly, what shall I say, ulcer producing business. with the rents down as much as they are, the vacancies very high, the problems with COVID. The point I was trying to make is you can get returns that are at least that good with none of the heartache.
Okay. Do you include investments in equities such as Brookfield as an alternative form of real estate investment? I think that could be extended to other REIT as well.
Yeah, well, there's Brookfield Property, which is essentially a REIT, which is part of the Brookfield empire. And of course, Brookfield, a lot of Brookfield is big office buildings also. But Brookfield Property got really hammered because an awful lot of their properties were retail malls in the United States and also office buildings such as Canary Wharf in London, all of which suffered huge income decreases because of COVID. And I forget exactly how much Brookfield Property dropped in price, but it dropped very substantially to the point where Brookfield is buying back the shares and taking the whole thing private as part of a wholly owned subsidiary of Brookfield. In other words, the price of the units has dropped so much that Brookfield Asset Management, the parent, feels that it's a good buy just to buy the whole thing back off the market and that they can do better with it as a privately held part of Brookfield.
Our next question is, why do some REITs and ETFs pay out as interest and others as dividends? In fact, sometimes the bank changes the notation from month to month from interest to dividends.
Well, in fact, if you look at the distributions of REIT ETFs, they're quite complicated. They tend to have income. They tend to have a little bit of interest, not much, very few dividends, some capital gains, and as I mentioned, some return of capital. So as part of your research, you have to look at the REIT or the REIT ETF and see what its dividend, or it's shouldn't call them dividends, call them distributions, which is the proper term, because they're distributions, not dividends. And just see what they've paid out. And as I showed you in one of the slides, one of the things I like about RIT is that something like 70% of the distribution is either capital gain or return of capital, which is tax advantaged in a taxable account. But each one can be different. Each REIT can be different depending on the type of business it is, which is another reason why I prefer to own the ETF and not the individual REITs, because it's too much work figuring them all out. And by the way, it can change year to year. So.
Yeah. Yeah, and when you talk about this return of capital, people should remember that it's important to keep track of that because that has an impact on the adjusted cost base of your investment when you sell it.
Yes.
Next question is, what % of a portfolio would be reasonable? And I think that one we could link it to your buckets, Michael, your buckets of investments.
Yeah, I think it depends on what you're looking for. If you're in a situation where you need income, either to pay the mandatory minimum withdrawals on in a RIF, or you just want income to pay for your expensive travels like Alain, then you can decide what you want. But when we did the seminar, the last webinar that where we sorely missed your presence, Alain, talking about RIFs, one of the things that I showed was a model where we had about 25% in a dividend paying ETF, 25% in a preferred share ETF, and 25% in a REIT ETF. That just happened to be the model. So I don't think there's a number that says what's appropriate. I think it depends on your personal needs. I mean, if you're a relatively young person just starting investing, I'm not sure I'd even bother with REITs. I'd just buy a general all-in-one ETF and be done with it. But, you know, I designed these webinars talking to my peers, retirees, and one of the earlier questions we asked in an earlier webinar was, what do you want your investments to do? And most people said they wanted their investments to produce some income. So if that's the case, you know, 10% or more in a REIT ETF would, you know, make sense. I think in my personal case, I've got about 8 or 9%.
And of course, that depends on your financial plan, and that should be looked at periodically. It's not a question of having a percentage and never changing that. What about holding a REIT and pulling it putting it in a DRIP?
Yes, as well, if you don't need the income, having a REIT that drips, and DRIPS, just to remind people, stands for Dividend Reinvestment Program. And the way that works is that you set it up with your broker so that whenever the distributions are paid, rather than being paid in cash, they're automatically reinvested in new units of whatever it is that's producing the income. And yeah, that's a great way if you don't need the cash to increase your holding of the REIT ETF, or frankly, almost any ETF or stock. In fact, a lot of people argue that one of the best ways over time of building wealth is to reinvest dividends in a non-tax account and just let it build and build and build over time.
Yeah, although you have to remember that you will pay the interest or the tax, pardon me, on the distribution, depending on which form of distribution. If it's dividend or interest, those are taxed, even though they are reinvested automatically.
Right. That's why I'm suggesting they're great in a registered account where you don't have to worry about tax.
Yeah, yes, they're great in your TFSAs. Due to very low interest rate, could REIT be a good replacement for portfolio bond content?
Well, you know, that's a tricky question. And we have to go back and remember what bonds do today. You know, clearly bonds don't pay you any income today. I think a 10-year bond is now up around 1.5%. I think a 30-year is 2.2, something like that. But bonds are there today primarily to act as ballast in your account, so that should things go bad in the stock market, they will be there and they will still be worth what more or less what you paid for them. And in fact, if the stock market tanks, and the stock market will tank, let's face it. Again, as we showed in the webinar last time, there's a 20% or greater correction on average every 5 years or so. And so we're maybe due for one. And when your other investments tank, the bonds will be there as stalwarts holding up the fort walls. So they're not the same as REITs. When the stock market tanks, the REITs may well tank along with them. And I don't think that REITs are necessarily a good replacement for bonds.
Yeah, and that's one of the tenets of building a good portfolio is diversification. Don't put all your eggs in the same basket.
Just on that, I might want to say, you know, we all make a mistake of looking at our portfolio and looking at the individual pieces of it and say, oh, this went down, it didn't do well, I should get rid of it. But it's a mistake, and I do it too, I have to admit. You really have to look at your portfolio as a total and see how the total is doing, because certain things are offsetting other things. And, you know, for example, to digress a bit, gold has not been doing at all well over the past time, almost since March or April, since the stock market's done well. But, you know, if you remember my my theme for the gold webinar was gold as portfolio insurance.
Yeah.
And so when stock markets do well, gold does not tend to do well, and the reverse. So you have to look at things as a total package and not individuals.
Exactly. The next one is more a comment than a question concerning Brookfield, which we talked about earlier. Yes, it did go down, but it's now back up slightly and paying 12% or more per year. So that's more a comment on not looking just at the value of the investment, but also the stream of income that it produces.
Yeah, the only thing I would say there is that any investment today that's paying 12% interest should set off a lot of alarm bells.
Yeah.
Because there's a reason it's paying 12% interest. And the reason it's paying 12% interest is because people don't have a lot of faith in its underlying value. So if you're getting 6 times what you can get on a safe government bond, or 5 times what you can get on, a bank dividend, there's a reason.
Yep. As a matter of fact, there's a very well-known formula in finance that links risk to return. The higher the return, the higher the risk. Would RIT be a better buy and hold in a RRSP or TFSA?
I don't think it matters. I think it depends on what your needs are. Again, it's done well both in terms of income distribution and capital gain. So it's a nice way to have tax-free income in a TFSA, and it's also a nice way to hopefully build wealth in something like an RSP. But again, going to the future, one of the things that we, again, make a mistake as investors is trying to figure out what's going to happen in the future by looking at the past. And that normally doesn't work very well. So I think we have to think about the future. And that's why I raised the issue that it's unlikely that we're going to see these continued declines in interest rates. I mean, interest rates aren't going to go from 1% to -15. And so I think that implies that a lot of the growth in the value of real estate may be something that occurred in the last 38 years, but may not occur in the next 38 years.
Yeah, the same person asked, how long have you held RIT? I'm not sure that you want to address that.
No, it doesn't. No, I don't mind. I've owned it for about 4 years, I think.
Someone is asking about sharing the story behind the hats.
The story behind the hat?
The story wearing hats. Yes.
Yeah. The story behind my story behind the hat is that 20 years ago I had hair, and now I have a lot less. So I need a hat.
Well, mine is Michael's starting to wear a hat, so we sort of had it as a fun thing to do. But also at the start of the pandemic, or during the pandemic, I couldn't get a haircut, and my hair just looked terrible. Now I was able to get a haircut, but my hair still looks terrible.
I think you look very elegant, Alan.
I like my hat. Here's someone that wrote a rather lengthy set of questions. It would appear that REITs in general are less oriented to providing an income stream over the years than capital gains. Is that an accurate comment? And how can you determine if a particular REIT is and will be focused on income streams?
Well, I don't think it's an accurate comment. If you look at RIT as an example, it's yielding a distribution of around just under 5%, and its average annual return total is 9.7% over 10 years. So it's about 50% income and 50% capital gain. Some of the other ETFs have less capital gain. they're all yielding just under 5%. So no, I think, you know, they tend to be a pretty good mix of distribution or yield and capital gain.
Next question from the same person. If you own an investment rental property and have declared its revenue and costs over time, can improvements and major repairs be added to the base price of the home to reduce the capital gain on sale? The repairs having been claimed over the years as expenses.
I'll let you handle that one if you want, Alain, because that one's beyond my my purview.
It's really more complicated than just a yes or no answer. Some of the capital improvements may in fact be added to the capital cost, the initial cost, the base cost of the property. But generally, when you do maintenance type of expenses, they offset the revenues that you have during that year, but they don't impact the cost base, the original cost of the property. You really have to look at more than just do I add it or not? And that's where you need the help of a good accountant who's specialized in that area if you have a serious investment in rental properties. Next question is, if you have overlooked claiming an expense, how many years can you go back to claim the expense? Again, I think that would be related to owning a real rental property.
Yeah, again, I leave that to you.
That one off the top of my head, it would be, you can go back, I believe it is 3 years, but it may be as much as 7 years. So I'm not sure about the exact period of time, but you can definitely go back and ask for a reassessment of your income taxes for a period of time if there are some expenses that you haven't claimed in previous year and that are justifiable. Is the entire REIT market not projected to perform poorly right now?
Well, it's hard to say. I'm not sure what market is going to do well or not well. And frankly, I've given up trying to figure it out. Because whenever I try to figure it out, particularly in the last year, I've been wrong. CMHC came out last year with the prediction that the Canadian residential market was going to tank. Guess what? All of their experts were wrong. Now people are predicting that interest rates are going to go up because of inflation. You know, I don't know what's going to happen anymore. Actually, I guess I never did know what was going to happen. And so I've given up trying to figure it out. But the one thing that I do feel fairly secure about is that if you've got a good diversified REIT ETF, your distributions are likely to be pretty constant over time, regardless of what happens to the value, the capital value of the investment.
Yeah, and when all of the experts or pundits agree on one thing, it's probably time to look the other way.
Exactly.
Because most of the time they've been proven to be wrong. Next question here is, should you keep DRIP out of a taxable REIT investment? I think that's related to an earlier question.
You know, it's certainly easier to do it in a registered non-taxable account. But if you've got, for example, one of these online brokerage accounts, they're pretty good at tracking the DRIP investments and coming up with your average cost over time. And so it's making at least the accounting a lot easier than it used to be. But as Alain pointed out, you've got to pay taxes on those distributions every year, even though you're not getting them in cash, even though they're being reinvested. So it depends on your particular situation. I've got them in both accounts, both taxable accounts and TFSA, and I frankly just don't worry about it. You know, when you've got an investment that has returned in the order of almost 10% a year for the last 10 years, I'll happily pay my taxes.
A question here that's related to gold as insurance. Do you mean gold as metal, or gold miners, or gold ETFs?
Yes.
All three.
Yeah, all three. And we don't have time to get into it here, but basically gold miners or a gold miner ETF tends to about double the volatility of gold itself. So if gold goes up 10%, the gold miners tend to go up 20%. On the other hand, if gold goes down 10%, the gold miners tend to go down 20%. So having a diversified portfolio with some gold in it, both physical gold through an ETF or gold miners through an ETF, I think is a good way to spread out the risk.
Okay, here's someone here that added some precision to an answer that I gave earlier where I wasn't sure. The question of amended returns, how far back can you go? And that's from my friend Carol, who worked for CRA. So thank you very much, Carol, for that. Amended returns can go back 10 years. So there's a significant amount of time that you can play with here. Let's see here. Yes. Another question here. We have a lot of people thanking us for the presentation. Of course, Michael, your presentations are always very clear, very well done, and very much appreciated. We have a question here. Is it correct that borrowing monies from a HELOC to buy a REIT, the interest rate is tax deductible? And you talked about that during the presentation, Michael.
Yeah, in fact, there's been tax law through the tax courts to verify that this is in fact the case, that you can take out a mortgage against your house, and as long as you do it in the proper step, you've got to take out the mortgage first, then you buy the investment, and you show a clear link that from, then you can have a note or something, a clear link to shows that that mortgage was used to buy the investment, then the tax courts have ruled that the interest is deductible against the income from your investment.
Yeah, and it's very important, as you said, to do it in the proper sequence, so that there's no ambiguity that this borrowing, this loan, was in fact to generate either income or a gain, whether it's a capital gain or a stream of revenues that can be taxed eventually. We've come to the end of our question and also to close to the end of our time. So thank you again, Michael, for preparing and presenting these seminars. They've